Thanks for joining us here, coming a long way from Germany. I came here in 1975, which is almost 40 years ago, so I'm kind of the last generation. And I had the fortune to come at a time when the whole microprocessor technology was just beginning. You know, so Silicon Valley back then was a lot of more fruit orchards and empty fields, and it's a lot, you know, none of this is there anymore. But it's hard to talk about Silicon Valley without talking about Stanford University, and which is, of course, in the middle of Silicon Valley. And what's unusual about Stanford is that there's literally, you know, 1,000 startups that have come out of this one university, including some of the best-known names in the industry. And people keep wondering, like, why is this happening, or how can this be replicated in Germany or elsewhere? I should mention that Stanford is actually a fairly small university. It's only 18,000 students, 11,000 graduate students, and half of those are foreigners, by the way, or actually over half are foreign students. And it is, of course, well known for being the school you want to go to if you want to start a company. So there's some self-selection principle going on here, I'm sure. What one, I mean, these are just some of the names. There's actually somebody who made a study, and they concluded that the market value of just the top 20 companies that came out of Stanford is greater than $1 trillion US. And in total, all the companies that came out of Stanford have sold several $1 trillion of merchandise, which is hard to believe. But what makes Stanford special is that, next slide, it's in the right place. It is actually Sand Hill Road, where all the venture capitalists are, is actually on the border of Stanford University. You can literally walk to meet your favorite venture capitalists, which all are right on the corner, or better than that, they actually visit you at the university to see what's going on. But more than that, you know, people go there to think about starting companies. Basically, if you have a good idea, you want to, you know, take advantage of this opportunity. There's unbelievable networking opportunities, meeting people that have similar goals. In many of the companies on the previous slide, the founders of the company met at Stanford. They didn't know each other before Stanford. This is true for Sun, it was true for Google, it was true for Yahoo. So they actually teach courses in entrepreneurship, getting people in to talk about, you know, what it was like to start the last company. They have interesting courses in, you know, startups, business. You know, they have accelerators right on the campus, although they're also surrounded by yet more accelerators, and of course, you know, venture capital booth. So Stanford is unusual. Next slide. Now, the main thing I want to tell you, though, is you don't have to go to Stanford to start a company here. That is definitely not the case. And what you have to go to, of course, is to Silicon Valley, in particular to Sand Hill Road. And what is, you know, actually, I have too many slides, so we have to go a little faster here, sorry. There's this cartoon that somebody wrote in the late 1990s about what it is like to be a venture capitalist, and it goes like this. You know, you go to Menlo Park, which is where Sand Hill Road is, and you find a tree, and then you shake the tree, and the venture capitalist falls out. And before they regain their wits, you know, you shout your hands and say, you know, big data, cloud computing, whatever the latest buzzwords are. And then the venture capitalist will give you $4 million. You then publish lots of hype, hire lots of people, and go public. Take your money, climb a tree, and wait. So this. You will not believe how many, you know, successful entrepreneurs have turned to become venture capitalists and are sitting around looking for the next opportunity. This cartoon dates back to 1996. I changed a few words because back then it was like, you know, B2B and B2C. But next slide. What is true is that the amount of venture funding that is available here is just off the charts. Now, the peak was actually in the year 2000, and according to the source, they listed $100 billion of tier one venture capital. This does not include corporate venture capital or angel capital, but like real VCs that have invested. Of course, after the crash, this came down to about 20 billion, which was kind of the level before the dot-com boom. But interesting enough, this calendar year, 2014, at the current run rate, it's not over yet, they're heading towards 45 billion, I'm being told, which is actually the highest year since 2001. It's actually, it could be higher than 2001. It's actually the highest year since 2000. So the appetite for making investments has reached a new fever level. And the next slide, I tried, I'm not sure you can see this from the back. there's actually websites that count every deal and where did it go and what kind of company it was. So the top categories are software, as you would guess. More than 1/3 of all venture capital goes into software deals. Internet related, that's another 24%. Biotech is very high, and so is medical devices. But these top 4 categories, actually 87% of all venture capital. Nobody invests in chips anymore. I mean, that was like 30 years ago. Maybe once in a while is an exception, but it's hard to raise money for a chip company. But that's how it adds up. Now, the number of deals, that's the second column, and this is 2013 actual data. There was almost 4,000, I'm not making this up, 4,000 companies that got funded or Series B, Series C in 2013 alone. And the one thing I didn't show here is Silicon Valley. So this is all of the US, right? Silicon Valley is over 1/3 of that. It depends on the year. It's between 30 and 40% of all venture capital in the US goes to companies in Silicon Valley. So it's really incredible how much money is available here to fund new companies. And I know this, it sounds strange to people in Europe, but basically there's more money just in Silicon Valley than in all European venture capital combined by like a factor of 4. And that's just the way it is. Now, not it wasn't as happy back in 2008, 2009 because nobody went public. So what drives venture capital is actually exits from the previous company, which then allows people to recycle the dollars into the next company. So if nobody goes public, right, then it kind of slows down. But again, this is a good year. Now let's compare this to Europe. Next slide. So in Europe, there is venture capital. It's about 10%, and that's across all of Europe. Of the US, and that was last year, 2013, so this year maybe less. But UK is number 1, sadly, according to the source. France is number 2, Germany number 3. But you know the problem, right? It's really hard to get venture funding. The valuations are much lower than here. And the real problem is it's hard to exit. In other words, people, it's not that they wouldn't like to invest in something that goes public. It's just the chance to build a company go public is very hard. So what's the best strategy? Is to combine Europe and the US. There's nothing wrong hiring smart people in Europe. In fact, it's an advantage. Pointed out earlier, it's much less competitive. There's plenty of smart people. But you really need to have access to the US market, and both from a marketing standpoint and from ultimately raising money standpoint. And one recommendation would be to set up a US presence as either sales office or just sending somebody over here, early on. Because you will find more customers here than you will ever find in Germany, certainly. And there's one other minor point, which is, I'm not sure how familiar you are with US tax law, but basically, with the US worldwide taxation system, the US companies have a lot of cash that's parked outside of the US, and they have to pay a tax to bring it into the US. But one of the few things they can do with this foreign cash is to buy foreign companies, like a German or European company. So there's actually a valuation premium to finding good European companies that US companies can acquire, believe it or not. Okay, I think this is my second to last slide. So if you look at like one data point, which is like how much money is going to cloud data centers worldwide, almost 60% is US based. Europe in total is 24, but of course each country is just a slice of that, right? And the rest of the world is what is it, 17? Yeah. So bottom line, you have to be in the US to get access to these large markets. It's just, quick adoption, new products. People are more open-minded to try new things. And in fact, this is one of the biggest differences to me. Like in Germany, as a startup, you have a hot new product. In the US, people assume you're going to be successful, it's a good product, and they buy it, and they're not worried about you being around. In Germany, everybody's worried, like, do they have enough money? What happens if they don't make it? Maybe we shouldn't buy it, right? So there's a completely different attitude from a customer perspective to startups here than Germany. A few more slides. So in the US, of course, when people start a company and get it venture funded, you have to come up with a plan. And I'm not saying this lightly, but you've got to have a plan that gets like to $100 million or more, because otherwise it's not that interesting. And those are the companies, of course, that create the highest exit values for the investors, for the employees, and so on. And next slide. Believe it or not, in the US, every year, this is a study from the Kauffman Foundation, it depends on the year, of course, but there's between 125 and 250 companies, new companies, that reach $100 million revenue or more. Now, this is, of course, out of hundreds of thousands of people start, including mom and pop shops, but there's at least 100 to 200, medium, large, good-sized companies that could go public one day. And that's a good goal. Now, what is even better, of course, is to get to $1 billion in revenue. That usually takes a longer. And people have studied this too. So in the US now, since 1980, there was 7,500 IPO companies. This includes tech and non-tech. And out of this, about 5% got to $1 billion or more. But if you look just at the IT companies out of this, it's only 1% since 1980. Basically 70 companies, roughly 2 every year that get to $1 billion. But here's the crux. These 1% companies had more market value than all other 99% combined, right? Because they include Microsoft, Google, Cisco, eBay, whatever, right? So basically the premium to become one of the most successful companies is sky high. And of course, people really try to achieve this. And when people looked at what is the best strategy to get to these kind of large sizes, last slide. Oh, I'm sorry. The best companies from the 100 million point to the $1 billion point took only 4 years. The medium ones are like 6 years, and then there's a whole bunch of 12 years. And if you don't get there in 12 years, you most likely never make it. But there's actually a large number of companies that went from this sort of inflection point of 100 million to billion in just a few years. And when people study this, obviously there had to be a large market, for the product this company had, and there had to be what they call a sustainable value proposition, why your product and your service is better than others. And there had to be large customer base, marquee customers, and so on. But it's actually a fairly predictable thing for the right category in the right market at the right time. So basically what I'm encouraging you to do here is to think bigger, because in Germany it's like great to just get going, get some funding, get some initial sales. But you really want to think of a company as something you can build large. And that means you've got to go to markets where the market is large enough to support this kind of growth. And this is my company, which we just went public, so I'm not trying to do a sales pitch here. But we are now on a 500 million run rate, and we hope to be $1 billion next year. So it is possible. Great. That's it.
Talk about your Google investment.
Oh. Well, in my spare time, I sometimes invest in companies, and I met Larry and Sergey when they were still students at Stanford. And the true story is that they actually weren't sure they wanted to start a company, which I thought would be a mistake. And they were actually talking to Yahoo to sell their idea to Yahoo for $1 million. I mean, this is a true story. But Yahoo didn't think it was worth $1 million. So my worry was, this is unbelievable, right? Because Yahoo had a completely different business model. They did the CPM, editing the web page. They didn't believe in automatic search. So my goal for them was just to get going. They didn't have a company yet. So to make sure they got going, I wrote them a check to the company that didn't exist for $100,000, and they took the check. So that's how it started. Anyway, thank you.